Hey everyone, David here. Today we're going to be tackling a question. Can a charity-owned business be worth more than if the same business was owned by private investors? Stay tuned. I've got a couple of great guests here. We've got Brad and Nikita. We're going to be discussing this idea, how it would play out, and then we'll let you decide what you think would be the right move. I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium-sized businesses while controlling risk. So if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win. Welcome, everyone. Today, I am joined by attorney Brad West and successful acquisition entrepreneur Nikita Gossain from Australia. And today, we're going to be talking about buying businesses, but we're also going to be talking about a brand new concept that Brad's been working on about buying a business and having it owned by a charity. And so before we get started into this conversation, let's get a little bit of background info on the both of you. Nikita, why don't you start off and let us know a little bit about yourself and your background, and maybe you can tell us a little bit about some of the acquisition successes that you've had so far.
Thanks, David. My name's Nikita. I've been through and through M&A in my career, and I'm presently building a decentralized holding company, so buying very stable, yielding, specialized in niche cash flowing businesses, and looking to hold them forever. I think once you've got a business that makes a ton of sense and you know the asset inside out, why would you sell? So have purchased a couple of very specialized businesses in the agricultural sector, in the metals recycling space, in the industrial coating space.
Awesome. And can you give us an idea of sort of like the revenue ranges or maybe the employee headcount, just so people have an idea of how big these businesses are?
Yeah, for sure. In Australia, there's fewer private equity and other institutional buyers. So the largest I've purchased is about 5.5 million EBITDA Australian dollars, and smallest of those is 2.5 million Australian dollars EBITDA.
Right. So quite an accomplished career so far. Thank you very much. Brad, why don't you give us a little bit about your background?
Sure. I'm an attorney. I've practiced personal injury law, but I've always been interested in economics and how different incentives can affect people. And about 4 years ago, I was thinking about this. I was passing out my business card, saying, "Hey, if you want to some friends," and I said that if you brought me in some business, I would donate my cut of the proceeds to a charity of their choice. And it got me thinking more broadly about if we were to compete on who got the profits of the business. Like all the time I could go into a convenience store, I could buy something and it would just be like a bunch of random investors. I wouldn't know who's making the money. But what if a charity owned the business? What if a charity owned the profit rights, they could keep the operations of the business the same, so there's no reason a price would go up, but I could say help a kid not get malaria or help lift someone out of poverty. And I'm thinking that's not something I would be interested in. I think that's something a lot of people would be interested in. People don't want to pay more for stuff, and people want to, and this would be true for workers as well. People want to have meaning in their work. So if we could give people the ability to help in a way that they don't have to pay more or sacrifice something, I think that's a scalable way to do good. And that's why I came up with what I'm calling the charitable ownership advantage thesis, which is that the same business would be worth more financially if owned by a charity. It would make more money.
So basically, it sounds like the main thesis is that people in the marketplace, given all things being equal between two competing businesses, if they knew that one of them was owned by a charity and that ultimately the profits of that business were going to help that charity, that they would choose that service provider over the other one, simply because they thought that their purchase would be going to further good beyond the transaction.
Yeah, basically stakeholders like consumers, other businesses, media, employees, like all of their decisions go into a business's success. And so that would be a factor in their decision making that would give that business an advantage. And because that factor doesn't introduce additional trade-offs, like for instance, eco-friendly laundry detergent may not perform as well. Fair
Right.
trade coffee may cost more because you're paying more for the inputs to it. But charitable ownership, because that doesn't create those trade-offs that operational ethical business sometimes does, that would have an advantage without a corresponding disadvantage.
Okay. So, I mean, I've participated in various, let's call them charitable economic activities. When I was a Boy Scout, I used to sell apples for far more than the grocery store was selling them for, and I probably believe that people bought them just because they wanted to support the organization. And then, you know, uh, later on in my adult life, we participated in various fundraising activities and things like the Kiwanis Club and all kinds of stuff. And again, people are making purchases for me that are not, it's not the lowest price, way to buy whatever it was, but they were trying to support the activity. So I can kind of buy into this. Nikita, can you tell me about how you came across Brad's work and why you decided to get involved?
Yeah, for sure. I was actually introduced so Peter Singer met with me, who's a quite famous philosopher in the effective altruism community, I suppose you could say. He found Brad's thesis overall really quite compelling. I'm doing acquisitions of this type, and I suppose the intersection between these two worlds of ours, Brad and mine, was really quite obvious from the get-go. I want to add to what Brad was saying around these businesses have been around for 20, 30, 40 years, and post-acquisition, they will run and price and do everything that they've done in exactly the same manner that they have to carve out their niche and hold their position in the market for the 20, 30, 40 years. So, really a very different proposition to the Boy Scout selling the tomatoes or the cookies or whatever for a higher price.
Well, so that leads me to my next question then is I want to have an idea of what size of business, Nikita, do you think it would be required in order to meet those kinds of criteria, to really have sort of the governance, day-to-day management structure in place? Because as we know in the world of small business, a lot of small businesses really rely upon the efforts and knowledge and et cetera of their owner. And what we're talking about here is we're talking about putting an owner in place who's a charity, who is likely filled with people who are probably not business experts in the domain that the business may be in. So can you talk a little bit about that?
Yeah, for sure. We can touch on governance in a second. I think it's a pretty big topic to touch on in this context. But on the size front, from my experience, I believe 1.5 million Australian dollars profit is the right level to be looking at. There and upwards. So let's say between 1.5 and, like I said, private equity really don't play a great deal in Australia below the $4 or $5 million mark. So that whole space is really, available for the taking. I think I have purchased a business that was at 1.5 EBITDA, and it was probably not a very sophisticated 1.5 EBITDA. And I did find that both the risk and the pain, frankly, of transitioning from a very involved owner is quite a lot to take on, and actually quite a arduous activity. I'm never saying that these transitions are easy in these founder-led situations. They're never easy, but I can most certainly say that when I've put a CEO in place in one of my larger businesses from day one, a very thoughtful, organized transition plan to do the knowledge transfer, it's gone a hell of a lot smoother when the business is much larger. So build a really, I suppose, to have, at the end of the day, what we're trying to achieve here is a really defensible cash flow stream, essentially, for the charity that can solve, maybe in some world, their fundraising function, essentially, for the long term, and you want that business to be around 20, 30, 40 years from now. So it's got to be as much as it is a size game, I think it's also identifying the business with the right characteristics, and I think it's a very specific business you're seeking.
Okay. And so to acquire a business, typically there's a payment of some kind, or debt is taken on, some kind of way is used to raise the money that is given to the seller of the business.
Yeah.
And so what do you, either of you, how do you foresee this transaction occurring? Like, do you foresee it being a leveraged acquisition with some debt taken on? Like, and the equity portion, would that come from the charity itself? I'm just curious to see how you think this would play out.
For sure.
Do you want me- Yeah. Sure. Yeah, that's what we were contemplating. Yeah, for a normal investor, the equity position wouldn't really make sense because the money would be going to charity. So you would need to take the equity position, you would need a philanthropist, that's wanting to help the charitable cause that's being supported. You would need a foundation that's already supporting those charitable causes. So basically, you would need a philanthropist to be in the equity position. To be in a lender or bond position is actually pretty interesting because Nikita has done these acquisitions very well. She's dealing with businesses that have had a strong history of profitability. In addition to this, where we're starting out in Australia, the business actually doesn't pay any corporate income tax. So a normal business would be paying 25%. So if you had a $2 million EBITDA, a normal owner of it would be getting 1.5 million. They'd be paying a quarter of that, whereas the charity would be keeping the whole amount. So this is very protective of downside scenarios. You can imagine situations where a normal lender, they may not be able to meet the repayment obligations to a normal lender in downside scenarios, whereas the charitable owner comfortably could because they have 33% more profit. You divide 1 by 0.75, you get 33% more. So I think that this is potentially a very attractive opportunity for lenders who want to do good, because we could offer a market rate return, something like 8.5%, and it would be probably a more safe investment because of the tax advantage. And that's before you put in my theory into account, which is the charitable ownership advantage theory, that, hey, all else being equal, the B2B buyer of our products would rather have a social credential. All else being equal, someone would rather stick around, so there's more employee retentions. But even if you put that aside, you have this 33% more yield. So I think this is really attractive for impact investors, or even potentially normal investors on the bond side of things.
So just let me paraphrase this back to you to make sure I understand. So if you're going to buy a business, let's say it was going to be a business for $5 million, you're going to try to borrow some amount of that from a bank, but the equity portion, you'd be looking for somebody to donate that money to the charity. Would that then mean that we're looking for somebody who is going to make this donation and likely get a big tax receipt for themselves in making this donation, but that then becomes the equity contribution of the charity to do this acquisition? Did I follow that correctly?
Yeah. There could be, the equity would be tax deductible if someone made a donated contribution. We're not sure. We would like as much as we get, but there's also the possibility that we could finance it entirely through loans as well. But having 10%, 20% equity could de-risk it even further for the prospective lenders for the acquisition.
Nikita, what do you think? You've got some experience in doing some deals. What do you think the bank's appetite would be for this kind of arrangement in Australia?
Yeah, for sure. Banks here are receptive to cash flow lending. The kinds of businesses we're buying are not capital intensive, and that's intentional. We're not looking to have a whole great deal of maintenance capex. They are receptive to cash flow lends, and however, on my first conversation with the banks around this concept, It was pretty well a flat no. So it's taken a couple of iterations of the conversation to get to the place where we are right now, which is there is appetite for this kind of thing. It needs to be carefully considered and carefully structured, and obviously the underlying business needs to be a really particularly strong one. If it's project-based, for example, or any of these kinds of works that are a little bit more cyclical, that's not the kind of business we're talking about here. We're talking about that really steady, sustainable cash flow. So the bank actually is an option. I don't know where they're going to get to from a leverage perspective. I haven't gone all the way through credit to credit on one of the deals at the moment. We actually got stuck, frankly, at the equity portion on the last deal, and weren't able to get the deal off the ground, which meant that I ended up buying it through the normal way that I know how to do. But there is appetite on the bank front. I will also say that on the loans front, the loans don't have to be some sort of institutional capital. Potentially, we're exploring if there is scope for this to be loans on a normal basis or on a concessionary basis. Obviously, you're not going to leverage up the 100% of the thing, but a 10-year loan on one of these things. I will say 10 is pretty generous, but let's say 7 to 10 year loan on this thing at reasonable interest rates, and you'll get repaid all of that money, and you've essentially gotten the deal funded. The amount of equity that needs to go in a pure sense, as in the way that you're thinking, David, of like how much equity does the bank need, or do the debt holders need to see going into the business? It's not so straightforward in these acquisitions. I can say that I've done some that, as a result of deal structuring, have meant that there's not that much equity coming in on day one, as in much of the cash flow from the business itself has been able to pay earnouts and deferred payments and such. So there isn't this marriage to 50% equity going in by the banks here even. And again, coming back to the tax benefit, we are now talking about an uplift of free cash flow that's available to service debt, essentially.
Do churches in Australia make loans, do banks in Australia make loans to churches? Do you know?
Can't say I know the answer to that.
So that would be an avenue I would pursue.
Okay.
Because I have a little bit of experience with lenders making loans to churches and how they analyze those loans, because it's essentially a loan to a charity, and I don't know if a bank would ever want to repossess a church building. Like, it probably wouldn't be very good publicity, right?
Yes, which was the whole trepidation that the banks had. So it was just, how do we deal with it?
So, but what I do know is that it is a very specialized kind of lending, and I know that for people in the sort of employee ownership or cooperative conversion space, like a lot of these other sort of altruistically driven deal structure places, what often ends up happening is they end up having to create their own lending institutions.
Yes.
So there are these investment funds that are made up of donated money that where loans can be had to finance these kinds of transactions. And I'm just wondering if you've had a thought maybe that this is an avenue that might have to be pursued as well.
Yeah, look, full transparency, we don't have it fully worked out from a capital stack perspective. I will say the employee ownership funding arrangement situation has just landed in Australia. I'm talking kind of proper, reinsured by Berkshire Hathaway, and those kinds of lending institutions essentially are coming to Australia. It's all very new at the minute, but it doesn't seem the biggest roadblock in the context of what we're doing. Actually, I think from my perspective, obviously, I've got to be obsessed about it's got to be the right deal, and I think there's obviously many wonderful small businesses out there, but I think the risk that a charity should take on should obviously be really quite limited. So I'm really chasing this like very defensible business and an obsession about, is this business going to be around 20 years from now yielding cash flow, and how much cyclicality are we going to have? That's the kind of thing I just don't want to see. I think charities need to rely on stable cash flow, stable profits, stable donations, essentially. I think that's really the nirvana, and I think that these businesses exist, and the reason they're not so palatable for other investors is they're not they're never going to go on some growth journey. You're never going to be able to even probably double some of these businesses, but that doesn't mean they're not stable, defensible businesses that can produce essentially for a charity. So perfect. I'm almost perfect fit for the charity context, and as a result of probably very little buyer interest, you're buying them for 3, 4, 4.5 times EBITDA.
Yeah, I mean, the type of business you describe is the typical target of the single entrepreneur acquisition investor. I mean, looking for that steady cash flowing business that's dependable. Maybe there's not some tremendous growth available, but they think they can do something with it, right? Or at least maintain it and get some kind of return on investment.
Yeah.
But what types of charities have you had conversations with about this sort of idea? Can you name them or describe them, whichever you're able to do?
I might throw that question to Brad, but if you wouldn't mind, I'd just like to offer one insight into the Australian market, which is that the search fund community is brand new in Australia. It's really there's been like a handful. The first search fund was only raised in, I think, maybe 2021, maybe, don't quote me on that, but something like this. And so the search fund community is in its absolute nascent stage here. It is starting to grow, but you could count the number of search fund entrepreneurs. The independent sponsor market is also very limited in Australia. So the kind of potential single buyers that you're coming up against, it's really not a great deal. In my first business I bought, I reached out to him cold. There was no one else on the scene. And actually, unfortunately, he passed away not long after I bought the business. So it really goes to show the lack of succession planning that unfortunately is a really big reality in Australia.
I've been working with Australian acquisition entrepreneurs for probably over 10 years. So I've helped people with quite a few deals. Not the size of deals that you're describing, though. Usually more Main Street style deals. And actually, just over the last couple of years, I had two clients on the Gold Coast do successful deals. Businesses about half the size of what you're describing. So I know that there has always been a marketplace of people buying and selling businesses in Australia, maybe not within the framework of the whole search fund kind of thing. But tell me about the charities that you've talked with who might have some interest in doing this sort of thing.
Yeah, I would say charities that are doing like interventions directly probably wouldn't be the people that would be financing them. What would be financing that would probably be the foundations that are supporting those charities. So like if like the Gates Foundation was like supporting a bunch was for instance supporting the Against Malaria Foundation. Against Malaria Foundation does like the direct work, and so like the Gates Foundation would have an investment portfolio. They have a corpus. And they could, acquire the business, and they would be supporting it. So, I mean, I've discussed with like the Life You Can Save Australia, which distributes funds to a number of in markets, different effective charities, preventing poverty and disease relief. But I wouldn't be like going to the Against Malaria Foundation or like Give Directly or the organizations that are directly doing the interventions and looking for an investment. I'd probably be talking to foundations that are investing money for long-term support of charitable causes, or I'd be talking to impact investors. And I think that's another set of actors that may be interested in funding this, because they're sort of looking for an intersection, right? They're looking for an intersection of where's a kind of business that where through its operations, usually it's able to have a positive effect in the world. So that's one circle in the Venn diagram. And the other circle is what's something that we can make some money or a reasonable return at. And so impact investors are looking for the overlap of these two circles, which is a difficult problem. I think profit for good businesses, what we're describing, sort of solve that problem, because if these businesses are more profitable than normal businesses, we could offer a market rate return on their bonds, so they could get that first circle of a reasonable return. And if they outperform other businesses for a combination of tax reasons, for the stakeholder advantage reasons, people would rather buy from them from competitors, et cetera, with employees, then you're not dealing with a small overlap, you're dealing with most of the economy. So I think that that's a potentially attractive opportunity for impact investors and potentially just the normal credit economy.
So a lot of these foundations typically don't they operate investment portfolios like endowments and things to generate money from? So in essence, they're already in the investment management business, correct?
Yeah.
And so what you're trying to do is get them to see these smaller businesses as an option for their investment funds,
Yeah,
basically.
they're leaving money on the table. Essentially, either through the Australian economy, they could be getting a larger advantage just with the tax advantage, or with the entire global economy. If my theory that people would rather buy something in a way that helps people if it doesn't cost them anything more, if that theory is correct, then they're leaving money on the table throughout the entire economy. Basically, what I'm envisioning is we should be on the same side. Philanthropists that are trying to use their money to better the world, and consumers, employees, all these other economic actors, we should be working together. Philanthropists giving people the opportunity to buy things that help people without paying more. And the people of the economy, like, hey, if I'm going to be buying something anyway and I don't have to make a sacrifice, we're going to be doing it. So the way, in one of my articles, I say the war philanthropists don't know they can win. Basically, they should be coming in the economy and taking large market share from normal investors, because they have an advantage that can't be replicated.
Yeah. And I'm sure, David, your audience is very aware of the almost succession crisis, I would call it, in the context of Australia, because there aren't buyers for this size of business, as you well know. So the next decade, as the baby boomers retire, we are really seeing an unprecedented opportunity actually to acquire these businesses.
So hang on, but that narrative actually doesn't jive with my own personal experience, because what I see is I see an incredible number of acquisition entrepreneurs chasing the very small number of very successful small businesses, and 80% of small businesses aren't actually worth buying. So it's a Pareto principle kind of market where it's easy to say, hey, there's all these millions of businesses and we don't have enough buyers, but 80% of those businesses shouldn't be acquired. Like they should just close up. Really,
there's something actually that's pretty interesting there, which is the smaller the margin on which a business operates, potentially the larger opportunity. Because if you have a 30%. I'm sorry, what were you going to say?
I was going to say facilities management always operates at kind of almost single-digit EBITDA margins.
Yeah, and so if you had a very large margin business, like 30% more revenue than cost or something, and if my stakeholder advantage, the charitable ownership advantage theory, offers a 3% advantage, that's only a 10% increase in profits. Whereas if you had a business that was on a 3% margin, it only had 3% more revenue than costs, and you have this employee retention advantage that would reduce costs, or you had a bit more sales, that could translate to a larger profitability effect. So I think that it's somewhat interesting looking at this 80% of the businesses that are not worth buying, and so you could probably buy them for a relatively low cost. So it makes me wonder, is this a huge opportunity for profit for good businesses to cheaply acquire businesses, get this stakeholder advantage wedge to get this margin advantage, and have an acquisition opportunity that would be relatively worthless to a normal investor, but could be worthwhile for charities to buy businesses for pennies on the dollar.
Why do you suppose maybe the manager of a charitable foundation has not already had this idea or moved into this space before?
That's a great question. I think that they've sort of been on different sides of the ledger. I think that most of the innovation has happened on the interventions, like what kinds of charities we should be doing, what kinds of stuff that we should be doing. And in terms of the investment, it's just been normal, conventional investment. And there just hasn't really been much thought regarding, how can I have an advantage due to my identity as a.
But do you think perhaps liquidity and risk could be really high in their list of concerns? Like if they're buying government issued bonds and publicly traded securities, there's instant liquidity at any time. There's risk mitigation if you're buying from like a bond from a government, for example, versus what we see in the small business market, which is typically far riskier. Like, do you think perhaps there's a mismatch in the risk profile that some of these managers might be trying to achieve with the allocation of their funds?
I think
Yeah.
go on, Brad, if you want, but I think probably my personal view is I think the perception of risk doesn't match the reality of the risk in the context that you're talking about. I think if we're talking a business that has reliably generated, let's say, $2 million of EBITDA for the last 20 years, which that's not some, needle in the haystack nirvana situation. These businesses do exist in Australia. And actually, personally, when I'm looking at businesses, I'm not going to lie, I feel probably spoiled for choice. I don't think there are enough buyers in the Australian market relative to the number of purchasable businesses that actually would be worth the transition. So I think the perception of the risk is greater than the actual reality of the risk. Obviously, from a structuring perspective, it all needs to be done incredibly well to ensure that protection of one's rights and such. But I think situations in which this isn't your classic LBO, this isn't we're leveraging the thing up to the hilt and we're going to try and, this isn't that proposition. And so a case of permanent capital impairment really doesn't, to me, in the context of the business that I've got in my mind for what we would buy for this proposition, really isn't, I don't think, matching to the potential risk that a foundation manager might be seeing. And I can probably comment quickly on the liquidity front that, let's talk about some nirvana where if I don't know, $10 million of donation at the end of financial year was going to come to the Life You Can Save, for argument's sake anyway, why not have that $10 million be channeled to the purchase of a business? It can go in entirely as philanthropic capital. And now from day dot, you have got liquidity, essentially. That money is going to, if it all came in as philanthropic dollars, not as concessionary loans or any type of loan, if it all came in as philanthropic dollars, 100% of that free cash flow is now from day one going to be channeled into
You're talking about an unleveraged acquisition, just cash purchase.
I'm talking cash purchase, but even let's talk leverage. Like the leverage, like I'm happy to share in detail the model with anyone that's interested. But from a financial modeling perspective, you don't have maintenance capex in this business, and you've just eradicated your tax. So the free cash flow, you can imagine, that's falling out of this thing is very nice. It's very capable of servicing a medium level of debt.
Okay. Well, I've got a few more questions for you. We're just going to take a brief little pause. Today's live stream interview is brought to you by Xero, the cloud-based accounting software package that makes sense for my small business. Look down in the description to find a link that will give you, as at the time of this recording, 90% off your first 6 months of subscription. You'll also find a link to the video in which I explain why I chose Xero for my business. So I want to take this from a different angle, because we're talking here about a charity or a foundation buying one business and then channeling that cash flow back to the charitable pursuits that they support or they want to do. There has been a big movement over the last few years through like B corporations or like more community and whole stakeholder focused sort of intentionality in business. Do you think that what would be the big difference between this arrangement that you're suggesting, where a charity owned the business outright, versus, I don't know, some kind of effort to try to get 1,000 small businesses to all agree to give 1% of their profit to charity? Like, do you think that there's any kind of credence to the idea that just getting privately owned businesses to give more might achieve the same kinds of ends? Or do you think that this strategy that you're talking about really has a durable advantage? And I'm guessing you're going to suggest the tax advantage, but as far as operationally long term, like when I think about things like this, I think, okay, what is going to happen, 30, 40, 100 years from now? Like, I don't know. Like, I know the Australian bond is probably still going to be good in 40 years, maybe, given inflation, who knows? But the small business, it's a harder question, isn't it?
If I may tackle this one, I think there are a few So yeah, the advantage to getting businesses to donate is that it wouldn't require capital. So it would be sort of free money from that perspective. But
Yeah.
I think that there are a couple drawbacks. One is, 1% of business profit isn't particularly attractive to the stakeholders. It's probably not going to move them as much. Like if I know all the profit is going to charity, that is probably a different. And I think there are studies that show that magnitude of the profit donation or whatever matters to the stakeholder. Like people prefer a higher percentage ownership. Another is a sort of structural reason. If you don't build profit rights into it or ownership rights into it, then what is that donation? It's a cost, right? So if you have a business that is more generous, donating 10, 20, 30% or whatever profits, it's basically putting a cost on itself, and it will either have to raise prices or its investors will not make as much money. That's why, for instance, a profit for a good business would defeat a normal business that would in the donation game, because while for a profit for a good business, it's just basically dividends, it's just normal business activity, and the appreciation of the value is inuring to the benefit of the charitable foundation. For the conventionally owned competitor, it has to increase prices to maintain the level of generosity. It has to lower. Yeah, that's why I think building profit rights into it is just competitively superior, and it's more attractive for the stakeholders. That's why I think that that's the route we should go, and it's much more scalable. If you are able to show, hey, these businesses are more competitive, they're more financially superior, then you can go to lenders and say, hey, we're going to acquire some more businesses. Here's the portfolio of businesses. Here's the difference in their profitability, and we're able to go more. So I think that getting businesses to donate more has the same problem that trying to get people to donate more in general has. People are selfish to some extent. And I am very glad that we have organizations that are trying to get people to give more. And I think they're doing wonderful things. But I think that this is the scalable opportunity. This is how we can go from making tens or hundreds of millions of dollars by persuading people to be more generous to taking larger swaths of the economy to be supporting effective charities. And don't get me wrong, I think that effective giving organizations are doing wonderful things and saving lives, and it's a wonderful effort. So I don't want anything I'm saying to, suggest something to the contrary.
Okay, let me take the thought experiment to the next step then. Instead of a company donating part of its profit, what if the owner of a company donated a part of their equity? Like, would that change what you just said? If all of a sudden the charity owned 5% of the equity of the company, then they would be entitled to the 5% dividend. They would have this profit right that you mentioned going forward forever. Would that be a different answer than on your part?
Yeah, I think that would address the structural issue you're talking about. There wouldn't be a reason that the business would have to raise prices in that. I just think that if the owner donated 5% and then went in with impact investors and got another 90 or 85 or whatever percent, enough money to cover that would be even more attractive for the stakeholders that make the business succeed, consumers who want to buy from it, employees. So I think that you could multiply the effect, and I think that's the 5% would be great, but if we were able to make it much higher, I think that you'd get a stronger financial performance effect.
We've been talking about an acquisition and structuring an acquisition, and you've even talked about how you might want to get people to donate money to be able to make the purchase of the business, for example. But have you ever had a conversation with an entrepreneur about simply donating the stock of their company?
Yeah, I think, I haven't had a conversation of it, but a huge instance of this was Yvon Chouinard with Patagonia, who
Right.
basically donated all of the profit rights to support the environment. I haven't personally had a conversation persuading someone to donate all of their, actually with Vincent van der Hulst, I think that I persuaded him to make it a structural thing, if I recall correctly. He has a used vintage jeans business in the Netherlands. But yeah, that can be very attractive to some owners of businesses to say, hey, the purpose of our business is going to be to help save the environment, to help end factory farming, to help lift people out of poverty. I'll give myself a reasonable market wage and I'll do well. And yeah, I think that's an interesting path. The thing is you're sort of limiting your source of capital, and that's it's to a very small set of people. So I think you should be considering the larger set of capital, which is philanthropic investments or impact investors for bonds. So I think that yeah, we should be trying to encourage entrepreneurs or owners of businesses to have that kind of remarkable generosity that we saw in Paul Newman or Yvonne Schoenard or Adam McCurdy or and Josh from Humanitix. Sorry, his last name eludes me.
Okay.
But yeah, we want to consider all the pools of capital and generosity that are available.
Okay. Traditionally, the owner of a business, their job is to make best efforts to make sure the company is profitable, efficient, look for places to improve the margin, raise the prices when they can, control the costs, all that sort of thing. Do you think without that kind of self-interest at the leadership helm that it will be difficult over the course of time for the business to continue to have that drive towards trying to be as efficient and profitable as possible? Nikita, you mentioned to me in our pre-call that the businesses that you have acquired, you have some professional managers in some of them. Maybe you can address this question.
Yeah, for sure. I think it's a really valid concern in that is the push behind the business now missing if this has become a charity-owned business? Because charities, whilst amazing, obviously aren't commercial functioning organizations that have a commercial edge. But I think what I can say on this point is that as much as I felt spoiled on the acquisitions front, I probably also have felt quite spoiled on the CEO or professional management front. I think there is a set of people that can be a wonderful, safe pair of hands that can receive great compensation for doing the work that they're doing, requisite to what they would receive in any other opportunity, including profit shares. The way that my deals are structured is either profit shares or equity that vests over the long term. I'm talking 10-year vesting of equity. So in this case, Brad's very interested in having a lock around the profits going 100% to charity, but that doesn't mean to say you can't have bonuses in place and keep everything very incredibly commercial. Again, it comes back to the size of business that requires that genius operator that is continuously hustling and continually pricing things, and they're doing the tendering and the quotes, and there's so much genius in their brain. That's not the kind of business we're talking about. For an example of the kind of business, I'll give a quick illustration of the kind of business I have in my mind for this proposition, essentially, and it's one of the ones that I own, which is in the grain silo sealing space. So those big, large-scale grain silos, we seal them. They're really quite large projects. Very nice EBITDA margins, has 40 years of IP built up on how to do these, basically has a monopoly on its niche. We're vertically integrated, so we're manufacturing one of 2 products approved for the grain sector in Australia. Just a really defensible business. The silos need to be resealed after about 15 years. We're doing about 6 or 7 per year, and there's about 200 in the network today that need sealing. And like I said, they need to be redone in about 15 years. So just a really dependable stream of cash flow that isn't going to be disrupted by the AI, it would take a pretty big decision from a customer to do anything else in that context with relation to that particular service, because if the structure is not sealed properly, they cannot fumigate the grain as effectively, and a lot of the fumigant escapes. So the business case from a cost perspective is very clear for sealing. And if they don't fumigate properly, they essentially are sitting on grain that they can't export. And then demurrage and other costs are accruing to the grain handlers. So this kind of structurally, I suppose it really all comes back to the timeless principles of investing, right? The moat and the defensibility and it's it's all within the structure of the entity, right, that makes this thing defensible and means that it can persist for the long term with professional management.
When business owners have been successful for a long time and they have in wealth independent of their business, they're very wealthy people, they've got other investments and everything.
Yeah.
Oftentimes they will look at an exit that is more geared towards legacy or community. They might lean more towards selling to their employees in some kind of structure.
Yeah.
Do you think selling or donating the business to a charity should be up there amongst those considerations for people in that kind of scenario?
I personally love the idea. I've actually got a friend who has had this occur. So Oz Harvest Ventures, I don't know if I'm allowed to mention that, but look, they are in this space. They are pioneering this concept, and the real strong. Essentially, it was the lady who founded the business. It was her will that the business be left to the organization that she thought was doing amazing work. I think it's a really wonderful way to exit. And I think, as you rightly pointed out, legacy is one of probably, I'm going to say maybe with half of the business owners that I speak with, legacy is probably maybe the most important consideration that they have, because, as you're rightly saying, they have already created their wealth. This isn't a liquidity event that they necessarily need or that will change the course of their life.
Go ahead, Brad.
Yeah, sorry. I just wanted to go back a minute. You're talking about basically equity compensation or equity ownership by management, and basically we need management that has proper incentives, proper alignment, and then you look at say Fortune 500 businesses, how much there is equity compensation, there is that incentive, but it's maybe 1% of the business. And when you're dealing with a $10 billion business, that 1% is $100 million. So that's a lot of incentive, but you're still talking about the vast majority of the business that isn't involved in the management and could be charitably owned without impairing the performance of the business. Even with the lower middle markets, you're still talking often with acquisitions in which LPs, the limited partners, have most of the equity, and you have a smaller portion of the equity that's held by people that aren't involved in the management or governance of the business. So I think that charity ownership of it is very similar in a lot of ways to the current economy, in which you would have a passive investor, someone an entity that's not much involved in it, but still the profit rights that are going to most of it. I think that's part of why Profit for Good is so clean, because it's not necessarily changing much about the economy. It's just making that private investor do something. That is to say, make it more attractive to the stakeholders. Whereas currently, it's not really doing anything other than the initial capital outlay.
Yeah. I think this has been a fantastic conversation. I think you raised a lot of interesting questions. I think the fact that this could be done with the removal of the tax burden in Australia makes it an ideal scene for a case study to really see what happens with this business. And I would love to know what happens, after 20 years, right? But of course, that's a long time investment ahead of us. Yeah. My own fear with this concept is if the wrong people get into the management and the people in the charitable ownership do not have the knowledge, savvy, et cetera, in the business world, that you could have a scenario where the owner or the manager rather starts to manipulate the board and really conducts things to their own benefit, which is something that, let's face it, happens in public companies too, right? Without a real loud voice for ownership. And this is why we get these activist shareholders or big pension funds that have to rattle the chain every once in a while to get things in order. That would be my concern. But those sort of governance issues, they happen whenever you get that divorce between, I think, leadership and ownership in any size of business.
For sure. I think you've actually hit the nail on the head. I think in terms of this whole structure, the governance has to be, obviously the acquisition needs to be right. That's a foregone conclusion, but the governance needs to be pretty spot on. I think advisory board plus proper governance and special advisors potentially to the organization that is going to be receiving the proceeds. So maybe potentially even some of the people that were involved in the philanthropic donations are the ones that sit on the board just to make sure that things are really going the way that they need to. But I think you've hit the nail on the head. If there's any limit to scalability here, from my perspective, I don't think it's availability of targets. I don't think it's availability of people to do these deals. I think as much as the skill set is kind of kept quite under, people that have the skill set generally try to keep it quite close to their chest. I do think there are plenty of people out there that could execute the right deals for these charities. I think the limitation definitely is going to be on absolutely nailing that board. There's no question. That's the make or break really here, if there is one.
Yep. But that's the same issue that we see broadly within the economy, in which management is separate from profit, right? So that's something that the whole economy is solving for every day. So I don't see this as a unique problem, but rather one that's shared with a agency separation problem that we see in normal businesses. And we seem to have these large companies, and it seems to work for private investors who aren't involved with the management of businesses. I don't see why it wouldn't work with a charity or a foundation playing that role. I don't think it introduces special problems.
Yeah, sorry, I should have clarified. I think my view is that would be the problem at an individual investment level, if you want to talk about it at that level, that I could see something going wrong. But I think at a macro level, in terms of this concept, in terms of the scalability, in terms of achieving really outsized impact through this model, I don't think that's really a factor, because it's a problem that exists, or it's a reality that exists in everything. And solid governance is something that there is plenty of resource around, and training and all sorts of things. And it's about the composition of the board and the right people on the board.
Well, listen, I think this has been a very interesting conversation, and I'm looking forward to seeing what the viewers think. If you're watching or you're listening on the replay and you've got some experience that leads you to have an opinion about this, or if you've got a thought or an idea, Brad and Nikita are going to be coming back to visit the comments of this video. So put your comments down below. Let them answer your questions. I will leave my feedback as well for anyone that leaves a comment down below. And I'm looking forward to seeing what people have to say. And I want to thank the two of you for taking the time to join us here today. I think it's an interesting idea. And as the baby boom generation who own a ton of businesses are heading into retirement, the ones that have good, successful businesses that deserve to carry on are looking for ways to exit. And you know what? Maybe if they aren't that good, but they still earn some money, if we don't have to apply leverage to acquire them, maybe they might still make sense for an acquisition too. I'm just realizing that now. So this could be something for someone to think about if they want to see that their business carry on, and they don't necessarily need sale proceeds to help fund their retirement. So I want to thank the both of you for stopping by here today.
Thank you. Appreciate the challenge. I think it was very valid and insightful. It was good to really get into the weeds of it.
Yeah, no problem. I like to think up questions.
Amazing.
Thank you so much, David. Thank you, Nikita.
Thanks. Have a great day.
Thank
Bye.
you. See you later. Bye-bye.
Awesome. I hope you enjoyed today's video. Before you go, I'd like to invite you to come visit my blog site over at davidcbarnett.com. It's full of information, links, and details about my products and services. While there, join my email list. That's where I share practical ideas about buying, selling, financing, and managing small and medium-sized businesses. I make complicated business topics simple, useful, and grounded in the real world. Also, if you're going to be a successful entrepreneur, you need to know your numbers. Check out my newly updated cash flow forecasting and business plan writing program online at bizplanschool.com. This program teaches entrepreneurs how to build a financial forecast and business plan from the ground up. It's designed for people starting or buying a business or planning a major expansion. The goal is not just to create a document for a lender or investor. The real goal is to understand whether the business or the deal actually makes sense. Learn more and enroll at bizplanschool.com.